Okay, good evening, everybody. If you can hear me, can you please put it up on the chat button? Okay, thank you very much. Yeah, good evening. Thank you. Thank you. Okay, we're going to start straight away from where we started last time. We are on IAS uh, 19, right? Um, Employee benefit. I think I'm correct, Abi. Please let me know if I'm correct. Okay, because most time I don't really have time to check all this what's it called, this lecture material when we stopped last time. I just log on to the system um, and take the lectures. All right. So I think we're on S19, yeah, and we've been able to take a look at the two types of employee benefits. Thank you very much. Okay, so we are on S19, so I'm correct. All right. I've been able to look into employee benefits and the two types that we have, the defined contribution plan and the defined benefit plan. So we're able to explain the differences between the two in case your examiner is picking you up on, the written aspects of IS 19 or trying to ask you to differentiate between divine benefit plan and of course divine contribution plan. Okay. Then we went ahead to look at the accounting treatment for divine benefit plan because that's the pensions accounting when it comes to IAS 19, okay? And we were able to look at our pro forma that you really need to understand properly when we said that pro forma is an adjustment because you needed to present the net position of your employee benefit into your financial statement. So what it means is, if I'm going to pay my employee at the end of 20 years or 25 years, I don't wait till that time till I start looking for the money. So the entity can decide to, have a planned asset where they, contribute money or pay some amount of money to a separate entity. Okay, so that that asset will grow, and of course, it's going to be invested, and more money can be quite sufficient, probably to pay termination benefit or post-employment benefit. And of course, as it says, plan assets should be measured at its fair value, and the plan liability should also be measured at the present value, right? So that's why in our pro forma, you needed to discount the net position at the beginning of the year. So you look into your net deficit or assets at the start. That's the carry brought forward, okay, and you discount by your net interest component. So we said our net interest component will either be a charge or a credit to the profit or loss account. And then you also look into your service cost component, all right? So that's the way you attack any question on IS 19. Where is my service cost component? We said three things, constitute our service cost component, which is what's it called now? Current service cost, past service cost, and of course any gain or loss on settlement. All right, and there's going to be a charge into your profit or loss account, and of course you also take into account contribution made into the plan, and the benefit paid is always new. Okay, and because of the differences between what the accountant has computed and what the actuary has also computed, has always a difference because sometimes the actuary base its calculation on assumptions, right? Okay, so that's why we now have a measurement component. Okay, so that's when what we did the last time. So I didn't want to really take you further so that I can use the next lecture to do some kind of revision for you. So I can assure you, you're going to see IS 19 in your exams, all right? And I've put one question there. It's just a question. Make sure you practice that question. I'm going to show you at the end of IS 19 before we move straight away to IFRS 15, revenue from contracts with customers, okay? So don't joke with IFRS 16 leases Don't joke with IS 19 and don't joke with IFRS 15, right? So they are very key at this level. Of course, your IFRS 2 share-based payments, okay, I've tried to break them down for you. So we just needed to look into two more things here. I'm going to take you through containment and of course asset stealing. Then probably we look at one more question. Then we say bye-bye to IS 19. And in fact, I've met my target already when it comes to, the standards, key standards I really need to cover. But notwithstanding, by Sunday, by God's grace, we're going to check ratio analysis so that you are conversant with the formula ahead of time. So I'm going to be taking you through how to generate those formulas. You don't really need to, cram them, right? So they're able to do that on Sunday, then probably on Tuesday, I'll take you through IS 38 because it's quite important at this level. And of course, IS 37, that's provisions, contingent assets, and contingent liability. But if you want me to take you everything to 12 a.m., I'm ready, right? So obviously, you have a SFM, so we'll be able to do that. Okay. All right. But if I stumble on any of those standards as we lecture, like I did in the financial reporting class yesterday, I will quickly take a look at that standard. I will use it as an opportunity to, remind you, all right? So that because there's no time again. Okay. If you notice, I've sent all your material to you. Okay. But I've not sent for IS 38, of course, 37. So I'll try and prepare it probably tomorrow or next and I'll send it to you ahead of time. So print them out, start reading. Don't wait for the class, all right? Start reading. So that when we get into the class and I explain, it's quite easier for you. So keep reading, keep reading. There is no time again. So let's take a look at containment. We said containment is when there's a material reduction in plan liability, right? Maybe some of your staff they resign. Okay, so that could be a containment, right? Or they were redundant, okay, because of a scale down in operation. So how do you, account for the net gain or loss on containment? So let's take a look at this illustration. I'm not really too sure whether I have an idea of that question. Well, obviously, once we know the principle, we just apply it on any question, right? So let's see. It said AB decides to uh, close a business segment. Can you see that? Said the segment employee will be redundant. Oh, that's it. I just explained that. I've not even seen the question. It said, and we pay no further pension benefits after being made redundant. Their planned assets will remain in the scheme so that the employee, will be able, sorry, their planned asset will remain in the scheme so that the employees will be paid, okay, a pension when they reach their retirement age. This is containment without settlement. Now, before containment, the scheme assets had a fair value of 500,000 and a defined benefit obligation, had a present value of 600,000. It's estimated that the containment will reduce the present value of the obligation of the future obligation by 10%, which reflects the fact that the employee will not benefit from the network. Okay, so they'll be entitled to a smaller pension than previously estimated, required. Um, sorry, he said, what is the net gain or loss on containment? And how will this be treated in the financial statement? It's very straightforward. It's quite straightforward. So he said, before the containment, the planned assets, can you see, had a fair value of 500,000 and the defined benefit contribution, that's the what's it called? Defined benefit obligation, rather, sorry. Obligation, that's the plan liability, has a present value of 600. So it's now estimated that the present value of future obligation will now be, scaled down by 10%. Okay. So that means that should be 10% of 60. Is that okay? Because, they'll be redundant. So that means my liability has reduced and they will not have access to future increase in salary, right? Who would have estimated all those increases in salary in future periods Okay, so that's what will influence our what's it called, our contribution. Okay, so since they they will no longer benefit, then that means it's going to be reduced by how much? By 60. Okay, so that means the obligation will be reduced by 60. Okay, with no changes in fair value of the asset. You know, the asset will remain the same. So the reduction in the obligation now represents a gain on containment. So it's a gain which will be included as part of service cost component. Is that okay? So to be taken straight away to profit or loss account. It's very simple. Okay. So this is how you do it. So let me quickly show you. So before the containment, how much is the present value? Can you see that? It's 600 of the obligation. How much is the fair value of my what's it called? Of my planned asset? That's 500,000. So when I calculate 10%, because of the redundancy, I have 60. So I have 540 as my what's it called? Obligation now after the containment. That's my planned obligation. My fair value of the asset remains the same. Okay, so I have a gain of 40. Okay, so it's a gain because my liability has reduced. Okay, so the gain on containment is 60, and this will be included as part of the service cost component. Okay, so in case the examiner should take you on separately on the containment, this is exactly the way we're going to present it to the examiner. Okay, it's just to break it down, but it's quite unlikely you see it separately like this. Okay, but in case you are seeing it in the exam. Okay, is the gain 40 or 60? Oh, that's a question. Is the gain 40 or 60? Okay. You know, when you net off your plan obligation and a planned asset, you have 100. Can you see that? You have 100, all right? Now, my containment is 60. So 60, if you remove 60 from 40 here, my net liability position has reduced. So it's 40. Is that okay? All right, so it's 40. So that's sorry, it's 60 rather. Sorry, it's actually 60. That's containment, okay? But the net position is now 40, okay? So my gain on containment is actually 60. So what it means is this 60 will be accounted for in my profit or loss account, or probably I take it as part of my service cost component. Is that okay? So I take it as part of my service cost component. So it's actually 60. It's just 10% on that 600. That's it. It's quite straightforward. Okay, but this is the way you present it in your account. Okay. Now I know why you're asking that question. So don't worry. Let's take a look at asset ceiling. You know, this is employee benefit, and of course, naturally, if you notice, the planned asset is in jacket. You know, normal mathematics will say that my liability should be in jacket. Is that okay? But that's not the case here. So that's why let me show you that pro forma again before I go to asset ceiling, so that we don't have this issue when we get there. So let me show you something on the pro forma. Now here, if I have a deficit, okay, you know, normally, you know, we said when you have a planned asset and a planned liability, it will always be on deficit. Your liability will always be higher than your planned asset. So any reduction in your liability is a gain. Is that okay? It's a gain because your staff, they are now redundant, right? So that means they don't have they won't take part in further what they call in salary future increases in salary again, right? So now, when you see net deficit here, it simply means my obligation is greater than my asset. That's why obligation minus asset. Is that okay? Now, this is my deficit. Okay? This is my deficit. Can you see? It's not in jacket. All right? So it's not in jacket. That means my obligation is higher than my planned asset. Okay? But if my asset is higher than my obligation, it will be in jacket. Okay? So that's it. I think that was why we had that issue over there, all right? So I needed to quickly explain that before we go to asset ceiling. So it's not the normal mathematics that if you have a liability, it should always be in jacket, okay? So it's just the opposite. So what this is saying is this is a surplus, right? And it will be in jacket because on a normal day, it will always be in negative. Now, when you now have a planned asset higher than your obligation, then you must not apply asset ceiling. Okay, you don't just recognize it like this. So if you see all the questions we have been doing, okay, or that we did last time, is negative. Is that okay? Then your net interest component is also something like this. Okay, it's only your contribution that will have that will be in jacket, normal mathematics. Is that okay? So let's take a look at. I think we are coming to asset ceiling now. I'm confused. Hey, you go see. You can't be confused. Let me do asset ceiling. Don't worry. I've said it. It's just the opposite of normal mathematics. Okay, just the opposite. Okay, so it's the standard. It's not me. Okay, but let's do asset ceiling. Maybe you understand when you get it. Okay. Let's see. Okay, let's take a look at this question. It's quite straightforward, but I'll just guide you to do this. Okay, it said the following before I go to asset ceiling. So let me remind us what we did the last time. Obviously, most of us we've not done revision. That's it, right? Okay. Now the following information relates to a defined benefit plan operated by Fraser at 1st January 20x1. The present value of obligation was 1 million and the present value of plant assets was 900,000. So they gave us discount rate, current and past service cost, benefit, contribution, and all of that. Now said, show how the defined benefit plan will be shown in financial statement for each of the years ended 31 December 20x1, 20x2, and of course 20x3. So if you have this question, just remember your pro forma. Is that okay? Because if you don't do that, we won't have the figure you're going to post into your profit or loss account, and of course your statement of financial position. Okay, so how will I start? I'll start from my net deficit or asset brought forward. Is that okay? So how do I do that? I will look at my obligation at the start of the year. Okay, so this is 20x1. So what is the obligation at the start of 20x1? So it said at 1st January 20x1. Can you see that? As once you can ask the right question, it's going to present it to you. Okay, said at the 1st January 20x1, the present value of my obligation is 1 million. Can you see that? So that's it. Then I ask myself again, what is the fair value of my asset, planned asset at the beginning of 20x1? It's going to tell me instead, and the fair value of the planned asset is how much? 900,000. So if you net it off, you have 100. Is that okay? Then for 20x2, how do you do that? You know, you are going to do them probably simultaneously. Okay. So how do I do for 20x2? So it simply means that the closing balance, okay, the closing balance or the closing present value of the obligation in 20x1 would be the beginning of 20x2. So it said the PV of obligation as of December is there. So now this is the PV, or that's the closing balance in 20x1. So this is the beginning of 20x2. Can you see that? So this is the beginning of 20x2. So this is my obligation at the beginning of the year. So what's my fair value at the beginning of the year? Can you see the planned asset for 20x2 is also 1, 2. So if you net it off, you have 1.3. You have that's 150, right? Okay. So that means my net deficit or asset at the beginning of 20x2 is 150. So you do the same thing for 20x3. So this is the figure you're going to take for your 20x3 at the beginning. Can you see that? That's it. All right. Now, and I'll go to the next thing, which is my net interest component. You know, we said net interest component is either a charge or a credit to P or L account. So you are going to use the discount rate at the start of the year to discount your balance or net obligation or asset at the beginning of the year. Can you see that? So it gave me 10% for 20x1, 9%. Okay, so that means I'll do 10% of 100 that we got earlier on when we net we did the calculation. Then 80% for 20x3. Then I ask the next question: where is my I've done my net interest component. Then where's my service cost component? Then you remember that your service cost component constitutes 3 items. Number 1 is your cost, past service cost, and any gain or loss on settlement. Then I ask the question: where is my current service cost? So if you see here, they merge it together. In most questions, that's what they do. And if they separate it, that's not a problem because you already know, what constitutes it. Okay, so you just pick up that figure. You said 125, 130, and of course for 20x3, 138. So when I have this, then I ask the next question: where is the contribution into the plan? Okay, this will always be in jacket. It doesn't really have impact on that pro forma or in my profit or loss account, so it's been jacket. Then I ask again, where's my benefit paid? So benefit paid is also there. Then you look into the question. Did the examiner want me to incorporate benefit paid? Once it's silent, then on your benefit pay, you just ignore to be dash, all right? You now go to the last year. What was my net position at the last year, okay? So for 20x1, what was the PV, okay, of my obligation? Can you see? For 20x1, it's straightforward, it's 1350, and of course, for plan asset, it's 1200, okay? And for 20x2, 13401150, and of course, you have for 20x3. So that net position, once you do that, you now remove it from whatever figure you have gotten after discounting, after incorporating your service cost component, and of course your contribution pay. The difference between the two will now be your remeasurement component. So you take it straight to your OCI. So let me take it. Let's take a look at that pro forma. Okay, so let's see. Can you see now? So this is it. Okay, did you remember we talked about this 100? Did you remember I talked about this 150 and of course 190? So now do your net interest component. Just 10% of this 100. Can you see that? And of course, what is this one? Okay. Is that a typographical error there? Okay. So I'm sure if you do the calculation, you have this 14 and of course this 15. Okay. Now you now go to your service cost component. Can you see that? Now, this is why somebody made a comment that is confused. If you notice, this is a net deficit, but it's not in jacket. That's standard, okay? So when you look at it, you are thinking it's actually positive. It's actually negative, but it's taken as it's the way it is a charge, okay? It's a charge, okay? So the way it is here is not in jacket, okay? It's only the contribution that you put into the jacket, okay? So if you add this up, and you meet 590, okay, so normally it should be greater than this. So that's why you're having this 5. So other ones are less. So that's why they are in bracket over there. And that's your balancing figure. So the best way to understand this properly is to practice, okay? So you need to practice, but just understand how it's all about or how those figures were computed. So in your financial position, the balance at the end of the year, that's what you show, okay? That's the net position. That's what you reflect in your statement of financial position. And of course, for your what's it called? I'm sorry, I'm going to attend to your question. Let me quickly explain this. And for your profit or loss, you have your net interest component, and of course your service cost component. Okay, it goes to profit or loss. So it's only your remeasurement component that goes to OCI. Can you see that? And here is a charge to profit or loss. That's it. So it's a charge to profit or loss. It's only when you have an asset, it will not be credited. Okay. So because if you notice, our service cost is, our net interest component can either be a charge, okay? It can either be a charge or a credit, but here is a charge, okay? Because it's not in negative, that's it. Because my plan obligation is higher than my plan asset, so it's a charge. Did you see that? It's a charge, okay? So the same thing with your service cost component will always be a charge, okay? Like we have seen now the last time, okay? So your measurement component, you have it there, okay? So that's what you do over there. So you just try as much as possible to practice that, okay? Let me see this question. This 10% of what gives 10, 14, and 15, okay? Let's see. This is my, what's it called? Okay, you calculate 10% of the 100 in year, when you net off your plan, what's it called? Let me see. Plan, asset, and I'm sure you understood how we got this 100, Abby. Can I do that again? They said the plan obligation at the start of 20x1 is 1 million, and the fair value of the plan asset is 900,000. Okay, so you net it all. We are just following the pro forma, so that's why we have this 100. And it said net interest component for 20x1 is 10%. So if you do 10% of 100, you have 10. Okay, and the net interest component for 20x2 is 9%. Okay, I don't have my calculator here. I could have tried to confirm those figures. Okay, but you can do that from your hand. So do 9% of 150, you should have 14. Okay, and do of course 8% of 190, you should have 15. Okay, so that's it. All right. So let's take a look at. You can look at that other exercise. It's very straightforward. It's just the same thing we have been doing. So let me now take you through asset ceiling. Now, we said we understand better now, okay? We understand better now. We said if normally your plan obligation will be higher than your plan asset, okay? Because you are having staff every time, they are getting promotion, salary increases, so there is no way your what's it called, your plan obligation will always be higher, okay? Your plan obligation will always be higher. Is that okay? So 8% of 150 is 12, not 15. Yeah, that could be a typographical error. Okay, thank you. All right, if you see those percentage in brackets, there's some figures there that are not supposed to be there. Okay, now what now happens if my plan asset, okay, is higher than my obligation? Okay, so let's take a look at this question to demonstrate that. It said the following information relates to a defined benefit plan. It said fair value of plan asset is 950. Did you see this? Now the present value of pension liability is how much? 800. And the present value of future refunds and reduction in future contribution is 70. Okay. Now, what is the value of the asset? Okay, what is the value of the asset that should be recognized in the financial statement? Now, listen. According to IAS 19, whenever the plan asset, that means the fair value of the plan asset, is higher than the present value of the plan of the obligation or pension liability. Okay. Now, the difference, naturally, you take it as an asset. Okay. As 19 now says no. The extent of the amount of assets you can recognize must be limited to the future economic benefit that can be gotten from that asset. Now, what does that mean? It simply means you need to take a look at the future refund or reduction in future contribution. So that extent, that's when you can now, recognize. Now, let's look at this question. Normally, if you look at 950 minus, how much is this? 800. I have 150. Okay, that is an asset. Naturally, I take it as an asset in my financial statement. Is that okay? Because the other ones, if my what's it called, liability is higher, I take it as a charge. Do you remember? Okay, because an obligation. Okay, but now the asset is now higher than the liability. Okay, by 150. So normally I'm supposed to take it into my what's it called, financial position as an asset. I recognize it as an asset. But as 19 says no, you cannot. You have to place a ceiling. Okay, you have to limit the amount you can recognize to the extent of future refunds or probably reduction in future contribution. Is that okay? Now, in this question, they now said the present value of future refunds and reduction in future contribution is 70. However, I have an asset of 150, that is potent for recognition. So what the standard is now saying is, I cannot recognize more than 70. That's it. So out of the 150, I can't recognize more than 150 because it's only, I'm going to get refunds of 70 or probably reduction in my contribution by 70. However, the difference between my fair value of present what's it called, fair value of my plan asset and the present value of my liability is actually 150. So I can't go ahead and recognize that one. It's just what we call prudency concept. Okay, you're just trying to be prudent. Okay, because on paper, if my plan asset is quite higher than my pension liability, that's on paper, it may not really be the case in reality. So I need to now consider how much refunds am I entitled to, am I going to get, and of course, the reduction in future contribution, probably because of containment and all of that. So That's what you have here. Now look at the way the solution has been presented. Can you see? It said present value of obligation. Did you see? Is not in jacket. Can you see that? And the fair value of the plan asset is in jacket. So because it's higher, you now have a negative figure. Can you see? It's not me, it's a standard. So now when I have negative figure, it simply means it's an asset. That's it. That's why I said it's the opposite of your normal mathematics. That, I was quick to say that because I know a number of us might be confused. And I also recognize that a number of us are also probably listening to IS-19 lecture for the very first time. Or probably you have even listened to it before now, but you don't even understand, okay? So that's why I wanted to take it on 2 lectures, okay? So that's why I stylishly delay it to today again so that I can use the opportunity to also, refresh our memory. Can you see now? So it's a negative, but okay? So, and, that is that means it's an asset, okay? So that's it. That means my pension obligation is lower than my planned asset. That's it. Now, the PV of future refunds is 70. So therefore, the asset that can be recognized is restricted to 70. That is asset ceiling. That's it. That's it. That's asset ceiling. That's it. Okay. I'm not really too sure whether I don't really think I've seen I can get into this level, including ACCA, because I tried to take a look at some of the questions around what's it called, around asset ceiling. I don't think I've even seen it, but it doesn't really matter. Let's endeavor to know it because it might be the only option for you. It's 19 when you get into the exam. So let's take a look at a question again. Now it said the following information relates to the defined benefit plan operated by HAC. It said present value of asset brought forward. Can you see? He has already calculated it for me. He said brought forward. Okay. Present value of planned asset brought forward. You see? So that's why you just needed to, be up and doing, and you know what you are doing and try to understand. He said brought forward. So you are not asking, for example, if you see this kind of question in exams, and you're asking, this guy told us so. Obligation. Where's my obligation at the beginning? Where's my what's it called? Asset at the beginning. You're just struggling. But here he said present value. Okay. Oh, sorry. Fair value of planned asset brought forward. He has done it for me. So he said it's 2,600. Okay. And of course, PV of obligation is 2,000. So I want to use this question to demonstrate that asset ceiling again. So mere looking at this, do you agree with me that the plan asset is higher than the obligation? So what happens? How do I present it? Now I will now ask this question: what is the what's it called? What is the value of future reform or reduction in future contribution? Because I cannot recognize more than that. So if you look at the difference between 2,600 million or 600,000 and 2,600,000 and of course 2 million, that's 600. Okay. Then I ask the question: every other thing will remain the same. You're going to do your what's it called? Net interest component, your what do they call it? Current service cost contribution and all of that. Okay. So you already giving me my discount rate here. Can you see? Because I understand the principle. So you just apply it to that question. But here there is an asset ceiling. Okay. The examiner will not tell you that this is an asset ceiling. But anytime you see that your planned asset is greater than your planned obligation, then you need to now ask that question: is there any restriction to the asset I need to recognize? So he said, HAC has identified the asset ceiling. Okay, they even mention asset ceiling here, but in case they didn't mention it, then you know what to do. All right, based on your present value of future refunds from the plan, and for reduction in contributions amounting to 200 million. Can you see that? So that's what my concern. Then I go, he said, explain with supporting calculations how to account for the pension scheme. So I bring my brought forward here, you bring the net position here, just like we have been doing, okay? You have your net interest component. How did you do that? Your 10%. Can you remember? But don't forget that this is now, can you see it's negative? Because it's an asset, okay? It's a negative. So don't let us be confused, okay? It's a negative because it's an asset. Then my service cost component to come, net benefit paid. The examiner did not mention anywhere where I need to incorporate net benefit pay. So it will be open like that, even though I was giving figure. Then my contributions will remain the same. Okay. Then what is my balance at the end of the year? Okay. It's going to tell me somewhere. Okay. It said future sorry, what am I saying? Yeah, future value of the plan asset, fair value rather, sorry. Okay, is 3.1. Can you see? And for obligation is 2.4. So if you take them off, you will have 700. Can you see that? You have 700. So it's still higher. Okay. So if you add up this, then you have 650. Okay. Then your remeasurement component is 50. That is understood. Everybody can do that one. Okay. So what now happens to ceiling? Okay. What happens to my asset ceiling? So normally I can only recognize 200. Can you see it here? That's my 200. You know the difference between 200 and what's it called? My 600 is how much? It's 400. That's why you have it there. Then you also calculate your interest component on it. Okay. So if you do that, what are you going to have? Okay. So if you say 10% of 400,000 or 400 million, you have 40. Abi? 10% of 200, you have 20. Is that okay? Your service cost component is 100. Every other thing remains the same. Then you just do your summation, and that's the end of the question. It's as simple as that. Okay. So that's the end of your question. So that's it. So that's how you just incorporate your asset ceiling. So just look at the question. Just put the figure here. Okay, that's the extent to which you can recognize. You cannot recognize the whole, what's it called? The whole, is it 400 now? Okay, you can't recognize it. Okay, so that's it. Okay, that's it. So take a look at that. But like I said, I've not really seen the examiner coming to that level. Okay, and that is the end of IS 19. Now, listen to me. There's a question here. Let me see. Did I put the solution here? Oh, the solution is there. Fantastic. Yeah, that's fantastic. Okay, but I have reasons. This is an ACCA question. Okay, now let's take a look at this question. I'm not going to solve it. The solution is there, but I want to prove to you that everything we have done, it cannot be. Your question cannot go beyond that. Okay, this is an ACCA question. It said, Macajoy, a public limited company, is a leading support service company which focuses on building industry. The company would like advice on how to treat certain items under IS 19 employee benefits. Okay, the company operates the company operates the Macajoy Pension Plan B, which commenced on 1st November 2006. And the Macajoy Pension Plan A, which was closed to new entrants from 31st October 2006, but which was open to future service accrual for the employees already in the scheme. The assets of the schemes are held separately from those of the company in funds under the control of the trustees. The following information relates to the two schemes. Everything I just read, they are just giving me introduction. They have not told me anything. If you understand what you are doing, okay? Okay, so I won't be surprised if you see this question in your exam, because I noticed recently, when trying to prepare materials for lecture and all of that, and I try to also take a look at ICANN past questions, and I realized that 90% of ICANN questions were from ACCE. In fact, there was a question I solved at the physical class. I think I showed you when we did IS-21, this Mimico question. Okay, Mimico, okay, on IS-21. That's effect of foreign exchange. In fact, I just saw it in the questions. Somebody now called me, and I also put a question in those notes. And I said, is solving a question aspire? That question is aspire. So I said, okay, read that question for me. So the person read the question on phone, and when he was reading, and I realized that it was the same content. The question I solved, in class over the weekend, and that was what the person was reading. I was like, wow. So I can't just pick that question, change the name, remove dollar, put naira, and all of that for IS-21. So over time, I've actually seen that bulk of those questions, are from, captured from ACCE. Okay, so don't joke with these questions that are here. Sit on them. Okay, then you're fine. And I also remember when there was time I was taking IFRS 8. Okay, that reminds me, we must take IFRS 8 operating segment. It's very simple. Okay, in fact, I showed them in class. I said, see, I can question, see the one we are solving. Are they different? And I saw those questions separately. I saw one from NCCA, then the other one from HICAN. They just lifted it and they push it to you guys. Okay, so don't really joke with them. Now, it said Maka Joy Pension Plan A. Okay, the term of the plan as follows: employee contributes 6% of their salary to the plan. Maka Joy contributes currently the same amount to the plan, for the benefit of the employee. On retirement, employees are guaranteed. When you see that, something should come to your memory. This is a divine benefit plan. Did you see that? They are guaranteed a pension for which is based on a number of years of service or whatever with the company and their final salary. They now give me the details. Okay, this is ACCA past question. Now here it said present value of obligation. Is it different from what we have been doing? It said present value of obligation. It gave us at the beginning of the year, okay, and this at the end of the year. Did you see that? Fair value of plan asset at the beginning. It was given, it was quoting date. So don't expect at the start of the year. The examiner will say at the start or at the beginning sometimes. Just look at the date. Look at the what's it called? Financial year end. Okay. Okay. It says fair value. Can you see? Okay. It now says current service cost. Can you see that? Pension benefit paid, then total contribution paid. Did you see? That's it. Is it different? You now said the measurement gain and losses are recognized in accordance with IS 19. And if I should ask you, how do you account for the measurement gain? You take it to other comprehensive income. Is that okay? So that's it. Can you see? I'm just trying to break it down for you. Now saying, assume that contributions paid into the plan and pension benefits are withdrawn. So here, the examiner wants me to do something to, what's it called? Pension benefits. Okay. So that means when I'm preparing my account, I need to take account of this pension pay. That's it. I need to take it into account. That's why I was emphasizing it earlier on. Okay. Now it now said under Plan B, what happens? It said under the terms of this plan, Maka Joy does not guarantee. Can you see that? It does not guarantee. So what does that mean? This is the divine contribution plan. So let's go to the requirement. Let's go to the requirement. It said in the requirement, it said, discuss the nature of and difference between a divine contribution plan and a divine benefit plan with specific reference to the company's two schemes. Did you see the way the examiner is asking here? Did you see? Is it really different from what we have been doing? Of course, no. Okay. Now say show how the accounting treatment of the two Maka Joy pension plans as at the year ended October 31, 2067 under IS 19. That's it. That's it. Okay. That's it. Now, so look at the answers. It's there. Okay. We've done it. All right. So we have done it. So that's it. And that is the end of what's it called? That is the end of what do you call it now? That is the end of IS 19. So this is the way you do the benefit pay. They said they are withdrawn. So you just put it in jacket. That's it. Okay. Thank you. So that's it. All right. So let's take a look at IFRS 15, revenue from contracts with customers. Any question for me before we do this? Okay, no question, right? Okay, so let's do IFRS 15. Okay, now revenue from contracts with customers. I think at this level, it was tested once. It has been tested once. That was May 2017. May 2017. And the IFRS 15 was effective 1st January 2018. And I can tested it May 2017. And that time, it was not the calculation part that was tested. It was just, I think they were just saying, explain the 5-step model approach to revenue recognition and accordance with IFRS 16. So, but so sorry, I'm trying to watch out for the network. Okay, so obviously IFRS 15 has replaced IAS 19, sorry, IAS 11 and IAS 18 revenue. IAS 11 is what they call construction contracts. Okay, construction contracts. So it will be replaced. This standard has replaced the two, and the idea is to improve on the weaknesses around IS 18, and to now have a more robust approach. Okay, sorry. That's the network. That was what I was trying to watch out for. It's quite frustrating. Sorry about that. Okay, now as I was saying, there are a lot of weaknesses around IS 18 revenue, and IFRS 15 is coming up with a more robust approach to revenue recognition so that entities can be guided accordingly. So here, in case the examiner, is trying to test IFRS 15, even if they are going to ask you the calculation part, be rest assured that they will ask you to explain the five-step model for revenue recognition. So in your notes, revenue IFRS 15 is a very big standard, but then I've tried to, really summarize it so that you can easily consume it. And in case the examiner is asking you, to make some explanation around that, then you know what to do. Is that okay? And of course, the objective is to, establish principles that an entity shall apply, when they are reporting, revenue. That's the nature, amount, or timing of revenue. There's so many uncertainties around the revenue as well. And if you ask me, if you ask me what's the most important item in the revenue, of course, that is, most important item of the financial statement, that is what they call revenue. Okay, so uh, that's why it's quite important that we learn the standard. Okay, now why was IFRS 15 issued? Like I said, to remove inconsistencies and weaknesses in the previous revenue requirements. So you need to know this, you need to put this in your head, all right? Also to provide more robust framework for addressing revenue issues. Now I've said that earlier on, to also improve comparability of revenue recognition practices. Let me explain this to you. Sorry, it's the network, okay? Let me explain this to you. Improve comparability. Under IS 18, most entities or entities uses what's it called, different approaches to revenue recognition. For example, you know, let's say you are a product-based company. Some companies will recognize revenue when goods has been invoiced. Okay, so that means goods is still in the warehouse, but since it has been invoiced, okay, they recognize revenue. Okay, some will also recognize revenue when control has passed. Okay, that means they have, they have dispatched the goods, not even minding whether the goods get to the customer or whatever. Okay, so there are a lot of ways or differences in which entities really recognize revenue. But IFRS 15 is now coming on board, to improve on comparability so that every company will have one revenue, five-step model approach to revenue recognition, and also to provide more useful information to users of financial statement through improved disclosure requirements, and of course, to simplify the preparation of financial statements by reducing the number of requirements in which an entity must refer to. Is that okay? So that's it. So try to know those things. Just put them somewhere in the corner of your head in case the examiner is asking you why. He will not just ask you what are the reasons for issuing IFRS 5. That's too direct, okay? Because it's not financial reporting class, okay? So, but they can frame a scenario and ask you required. Why do you think a multinational entity or entity, should comply with IFRS 15? Can you say that? That's the reasons. So you just have to be very alert to that kind of question, okay? Now, I needed to take you through on these key definitions. I don't want to assume that we know it, so that when we are solving questions, we are not wondering why this, why that. So my class, I want to believe you understand or you know the reason between income and revenue, okay? I'm sure you know the reason, the differences between income and revenue. You know it, Abby, so I don't need to explain, okay? Maybe you know it, so I don't need to explain. But in case you don't know it, let me know so that I quickly explain. Yeah, difference between revenue and income. Okay, now it's beyond what you see on your screen. It said income is an increase in economic benefit during the accounting period, and revenue is income arising in the course of ordinary business. Okay, that's okay. So I'm sure you know the difference, Abi. Okay, okay. So let's move on since you know the difference, and you also know what's it called? But if you don't know the difference, let me know. So just confess, I'll explain. But if you don't say anything, that means you know it. Okay. So let's look at contract. Of course, you know what contract is, Abi? It's an agreement between uh, two or more parties, okay, that create enforceable rights and obligations. So that's contract, right? So I ask you, supply me 100 cartons of phones, okay? And it's a contract, right? Probably we have an agreement, whether verbal, or documented. Okay, so that's a contract. Oh, okay. They are confessing. Okay, so I should tell you. Okay, well, let me explain. Thank you, thank you. So let me quickly. I thought we know it anyway. So okay, so let's see. Difference between income and revenue. Now, the money you got out of your ordinary course of business. Now, the reason why you are in business, that is revenue. Anything outside that is income. Is that okay? Now, if you look at an airline company, for example, why are they in business? To fly, Abi? And before you can fly, you must buy flight tickets. So the money they get or they made for or they are making from what's it called, flight ticket is revenue. Any other money outside flight ticket is income. It's taken as an income. Is that okay? For example, if you get to the counter and you want to fly and you don't pay for the flight, you cannot. They will deny you access, right? Except they give you maybe a rebate or whatever. Okay. But then if you now have normally you go with luggage, they will tell you, oh, the allowing luggage is, let's say for local flight, maybe 20 kg. For international flight, maybe 25 or 40 or 30 kg, depending on the airline. And once you carry more than that luggage, they call it excess luggage. Then they charge you, right? So, for example, they can say you pay 500 naira on excess luggage per kg. So, no matter, for example, and you have, let's say, 50 kg, so you needed to pay. Now, the money they get from excess luggages is income, not revenue, because they can allow you to fly without paying that money. But obviously, they can't allow you to fly without paying for revenue, what's it called, for flight tickets. Now, look at FCA, for example. FCA, the main reason why FCA or what FCA really do is to lecture, okay? And for every student, you must pay lecture fee. Worst case scenario is probably your lecture fee is discounted, okay? But any other money gotten out of what's it called, lecture fee, okay, it is income. For example, let's say before you log on to Zoom, you say, oh, your registration fee is 1,000 naira. Then your what's it called? Fee per paper is, let's say, 8,000 naira. Is that okay? So that is revenue. Then if you pay registration fee, it's not taken as part of revenue. Okay, it is other income. So that is why income is an increase in economic benefit. Income can also take the form of disposal of an asset. Is that okay? For example, you sell your asset at profit, then you take it through other comprehensive income. You don't take it as part of your income, part of your revenue. Is that okay? It can also be enhancement in asset. For example, if you value an asset, that is also taken as valuation, surplus or whatever. It's also part of income. Is that okay? So that's it. So the money you get out of your ordinary activity is your revenue. So I'm sure you can differentiate it now. Okay. I know you know it. It's not that. It's just that you don't know that you know it. Is that okay? So I've told you that now that you actually know. Okay. But that's very important as an accountant. You should be able to know that so that I don't struggle, especially if you practice accounting. All right. So let's take a look at contract assets. Now, this is the entity's, right to consideration in exchange for goods or services that the entity has transferred to a customer. Now, listen, there's a difference or a difference. Is it difference or difference? Sharp big one. There's a difference between contract assets and receivable. Sorry, I play a lot at the sorry. It's just because you are not in the physical class. In the physical class, I play a lot. But we still cover. Okay? So there's a way I try to make accounting standards interesting for my students. Okay, so you don't really run away. They are very simple. Okay, so don't mind me. Okay, so contract asset is I want to differentiate between receivable. Everybody, most of you guys are familiar with receivable. Oh, if I sell on credit, then I recognize receivable. But IFRS 15 is saying sometimes you might need to recognize a contract asset. So when do I do that? When do I recognize a contract asset and when do I recognize a receivable? Okay. Now I recognize a contract asset if I'm entitled to consideration. That's money after I have transferred goods, you know, to my customer, and the right is conditioned on something other than passage of time. Is that okay? The right is conditioned on something other than passage of time. But if the right is unconditional, it only requires a passage of time, then that is a receivable. When you sell on credit and you give your customer 30 days credit, okay, or 30 days period for them to pay, that means it requires a passage of time, all right? I will recognize receivable. Is that okay? But I said to you, but I did not give you, 30 days credit or whatever I'm expecting you to pay. But that payment, is conditioned on a performance that I needed to do. Okay? In that case, I will recognize a contract asset. That's it. So that's the difference. So sometimes you pick up a financial statement and you see contract asset, you are wondering, what is there? So it simply means it is not a receivable. They actually have right, to that consideration. It only requires a performance. Okay. Please take it again. Oh, Lua. Okay. So let me take it again. Okay. What should I take again? I'm not taking paracetamol. Okay, I should explain again. Okay. So let me do that. Now, a contract asset. Okay, okay. Don't let me even do what is on the screen. Let me just give you examples so that you understand. Now, okay, you are the company. Okay, you are the company you are selling, right? Let's say you are selling phones, right? And let's say you're selling phones, or let's say generating sets. Okay, and I come to your shop or your business premises, and I said I want to buy, generating sets, and all of that. Of course, now you have now transferred that generating set to me. So that means, maybe your engineers or whatever, they are transporting it to my base already, but I've not paid. Is that okay? I've not paid. Maybe based on agreement and all of that, okay? But I've not paid. Okay. Now I'm now waiting for complete installation. Once the generating set is working fine, okay, and I'm satisfied, that is when I will pay. In that case, you as a company will recognize a contract asset because that condition is not a passage of time. Passage of time is I come to your office or business premises. I said I want to buy a generator, and you now give me 30 days to pay. Okay, so that means it only requires a passage of time for me to pay you. In that case, I recognize a receivable. Can you see that? Okay. But if I don't have any agreement with you to give me time, I'm only waiting for your performance. Okay. Your future performance. Maybe you needed to come and install needed to come and make sure it's working fine before I pay. Is that okay? Then you can recognize a contract asset. Is that okay? I think it should be clear by now. So that's what the difference between receivable and a contract asset. Then of course, contract liability. You have collected money, but you have not done anything. Then you don't recognize revenue. That's prudency. Okay? You don't recognize revenue. So just like FCA, you have collected money from you, but you've not finished the lectures. So you can't recognize revenue. It's a contract liability because anything can happen. Maybe Zoom crash. Okay, that's why when we were planning for this program, we had a backup. That's Microsoft Teams, right? In case something happens to Zoom, okay, because I'm a risk manager, so needed to take a look at what can go wrong and try to prepare ahead of time. So, but then we needed to probably recognize a contract liability because you have collected the money. So in your accounting, you debit cash or bank, as the case may be, and you credit contract liability. As you are fulfilling the obligation, you now be debiting your what's it called, contract liability, that's your payables under your liability, and be crediting your your revenue. Is that okay? So that's it. Okay, and of course, you know what a customer is, Abby. So you are my customer, okay, or I'm your customer, and of course, performance obligation. I have reasons why I'm explaining this. I don't want to assume that we know it. We are still going to the middle of IFRS 15, so that when we get there, we are not struggling. Is that okay? So that's why I'm taking time to take all of this. And of course, performance obligation is what you promise me that you're going to do. Okay. So sometimes the performance obligation is we just supply you, all right? We just supply. So that means you are the one that we look for, maybe the engineer, people that we install, and all of that. And in some contracts, it's part of the contract. We supply you, we also fix it for you, make sure it's working well. So that's performance obligation. That's why IFRS 15 is revenue from contract with customers. Is that okay? So that's it. All right. And we have a standalone selling price. Now listen to me here. What is the meaning of standalone? Because we need this when we are doing our 5-step revenue model, recognition criteria and all of that, right? So my standalone selling price is the price at which the entity will sell a promised good or service separately to a customer. Okay. Now, for example, let's say you are selling phones, all right? You are selling phones and you also sell data, or let's say you also provide, let's say, network services. Is that okay? You sell phone, you also provide network services, or you sell data. Is that okay? So I come to you, I said, I needed 100 pieces of phones, and I also needed to provide me services, let's say, for the next 1 year. So we can have a contract together, okay? So because I'm, buying the phones and the services or probably data together from you, it's possible that the price will be lesser than if I'm buying them separately from you. Is that okay? So for example, you can say, okay, since you are doing that, then I'll give it for 1 million naira, for example, right? Okay. Now, but if I'm buying them separately or differently, okay, then you are going to charge me, let's say, 1.5 million. So that 1.5 million is what we call standalone selling price, okay? The price at which an entity will sell a promised good or service separately to a customer. Is that okay? So that's what we call standalone selling price. But if you are selling them together, most likely the price will reduce. All right. So we are still coming back to that when we taking by the time we are taking a look at the breakdown, the 5-step model. Right. Then we also have transaction price. Just like the example I gave, how much is the contract? How much is the transaction? It's 1 million. Okay, we negotiated and all of that. Then that is the amount of consideration. Okay. Now, you now have some key changes to the standards, right? I've explained them. The shift from sale of goods, timing, and the extent of revenue recognition. Revenue recognition is now measured at estimated transaction price instead of fair value and all of that. So I've explained that. Now, let's now look at the 5-step model revenue recognition. Like I've said, I've tried to summarize it for you so that you can, grab it and you can consume it, okay? And when you get to the exams, you are able to, put up a wonderful write-up when the examiner is asking you to really explain every question I've ever seen under IFRS 15. The first question has always been identify and briefly explain a 5-step model to revenue recognition in accordance with IFRS 15, right? So you may not really, avoid this if the examiner really decides to take you on IFRS 15. So let me quickly take you through the 5-step model, and I'm going to tell you the connection so that you can remember them, right? Number one is identify the contract with customers, okay? That's step one. Identify the contract with customer. What does that mean? I'm coming back there. Number two, identify the separate performance obligation within the contract. Identify the separate performance obligation within the contract. That's step two. Oh, sorry. If you notice, what I'm saying is not what is exactly on your screen, right? But they are the same thing. Most times when I lecture, I don't look at the books or I look at the screen. Okay, I think you should know by now. I think I've told you before. Okay, I'm just saying everything the way I've learned them. I think I learned IFRS 15 in 2017 when the standard was issued, and since then it has been in my head like that. So that's where I learned it from the original, what's it called, original standard issued by the ISB. All right. So they said identify the separate performance obligation in the contract. All right, but it's the same, right? So I'm just producing it the way it is in my head. But on your screen you see identify the performance obligation in the contract. It's the same. Okay. So if in case I'm not really saying exactly what is, you don't need to be fair. Don't entertain any fear. It's the same thing. Okay. Now, step three, determine the transaction price. How much? Okay, how much is it, right? So that is it. Determine the transaction price. And number four, allocate the transaction price to separate performance obligation in the contract. And of course, your step five is recognize revenue as or when performance obligation is being satisfied. So let me now take you through the whole 5-step model. Okay, so let me now try to explain. But before I explain, let me tell you how to remember them, okay? Or how to link them up. Now, your step one is, once you can remember step one, identify the contract with customer. Then you know that number two is, I need to, identify the performance obligation in the contract. What am I supposed to do, right? Okay, so what am I promising my contract, my customer? And of course, I need to know the price. That is step three, okay? Determine the transaction price. Then my step four is the combination of step three and two. Is that okay? Allocate the transaction price, can you see? Which is step three, to separate performance obligation in the contract. So you allocate step three on step two. That's it. All right. Allocate the transaction price to separate performance obligation in the contract based on standalone selling price. That's my step four. Can you see that? It's just a combination of my step three and two. All right. Then in my last, which is the last step, which is step five, is recognize revenue as or when performance obligation is being satisfied. So let's now take a look at the meaning. Now, identify the contract with customer. So it simply means that the customer has the intention and ability to pay for the promised goods, all right? And of course, that means it has the intention and has the capacity. A customer contract is not recognized if collection is doubtful. Is that okay? Now, the examiner can ask you, what are the criteria to be met before a contract with customer can be identified? You just tell the examiner that the following criteria should be met. That means number one, the customer must demonstrate the intention and the ability to pay for the promised goods, okay? Then both parties to the contract must approve the terms of the contract. The payment terms must be known, okay? How do I pay, okay? Do I pay, instrumentally? Do I pay outrightly, okay? Payment terms for the goods or services must be identified, and the contract must have commercial substance. What is the meaning of commercial substance? It simply means economic benefit will flow. Is that okay? So that is it. It's going to flow to you. So it must have commercial substance. Okay. So those are the criteria that must be met. And that is what I explained to the examiner. It's either the examiner asks you what are the criteria to be met, or they ask you explain the what's it called, the 5-step model approach to revenue recognition. And this is what you put up for the exam. That's the examiner. That's why I've tried to really summarize it for you, and I put it in a table. So in case they're asking you, please don't put it in a table. So you don't need to go with black crayon, blue crayon into the exam or watercolor and start coloring the way I've colored here. Is that okay? So it's just to, there's a way your brain can reconnect back to your books, okay, so that you can remember. So that's why it's like that. So don't go with crayon, color, ruler, and pencil, and try to draw for the exam. Is that okay? All right. So that's it. All right. Then your step 2, identify the performance obligation in the contract. So now here, what am I supposed to do? So that means the performance obligation is the unit of the account of revenue, and the following conditions must be met. There are 2 of them. 1, the customer can benefit from the goods or services, either on its own or together with other resources that are readily available. Normally, if you buy a car, okay, car will be enjoyed based on other resources like the fuel, okay? So you must be able to know that. That means they can benefit from it. The number 2, the promise to transfer the goods is separately identifiable from other promises in the contract. I can have more than 4, 5, 3, promises in a contract, okay? But the promise to transfer that goods can be identified separately. Is that okay? So that's the 2 conditions that must be met, when you come to identify separate performance obligation. That's why I call it separate performance obligation. Then determine the transaction price. How much is it? Is that okay? Now, and if you are doing that, you need to adjust for discounts, rebates, credit incentives, bonuses. Is that okay? Time value of money, okay? Non-cash considerations, even payment to customers, right? Non-cash consideration could be maybe you give them gifts, maybe T-shirts, some souvenirs, and all of that. So you use money to how would I call it now? To do all those things. You need to account for them when you are considering your determining your transaction price. Okay. Then step 4, allocate the transaction price to the separate performance obligation in the contract. So what do you do here? Performance obligation is allocated based on standalone selling price. I've explained standalone selling price the other time. Okay. So and I've told you what that really means. So that's what you are doing on your step 4. And of course, your step 5 is you recognize revenue when or as performance obligation is being satisfied. When you sell goods, it's quite straightforward. When you sell goods instantly, for example, you enter into a pharmacy and you buy a drug, the pharmacist, if there's no or any other condition, can go ahead and recognize revenue straight up. So that means step 1, step 2, step 3 is not even there. You just recognize revenue immediately. But when it now is now going to it's not a situation where maybe you need to supply continuously, or probably you are rendering a service, that takes over time. Okay, so that means you just have to spread your revenue over time, just like what SA is doing, like I said earlier. But if it's a one-off item and you sell it up, then you recognize revenue at a point in time. Is that okay? So that's it. Okay, so that's it. Why did this thing go back here? Okay, now there's something we call variable consideration. That means if a customer has a right to return those goods, then you must consider what we call variable consideration. So when we are going to solve a question around there, then you understand. IFRS 15 and judgment, I've explained this in my talk, so you just go through that. Okay, so let's now take a look at questions so that we end IFRS 15 today. And obviously next time we're going to meet by God's grace. I think we have what's it called, ratio analysis to do. Okay, so let's see this question. Let me just go straight to the requirements. Okay, all those things are just stories. Then itemize and briefly discuss 5-step model approach to revenue recognition under IFRS 15. Can you see that? That is what I've been saying since morning. Okay, so you have the solutions there. So, but I've summarized it for you there. All right. Now, I will also go straight to the requirements here. It said, discuss the criteria which must be met for a contract with customer to fall within the scope of IFRS 15. My class, this is what I've just said. Do you remember, under my step 1, when I said the customer must have the intention and the capacity to pay. Can you see that? A revenue contract with customer is not recognized if a collection is doubtful. Do you remember? Both parties must must agree to the terms of the contract. Payment terms must be identified. This is what they're asking for. Did you see? You don't need to run away. So that's why I'm taking time, to open your eyes to the nitty gritty of the way the examiner will bring you on. I'm pretty sure if I'm not really taking my time to do that, most candidates cannot attempt this question because the criteria that must be met for a contract with customer to be recognized, to fall within the scope of IFRS 15. But if you are very smart, in the part 2, it said discuss the 4 remaining steps. Can you see? So that means number 1 is just step 1. It's asking you to do. Say discuss the 4 remaining steps. So they are smart, automatically that they just want to explain, identify, identify the contract with customer. That's it. All right. It now said discuss the ways in which IFRS 15 attempt to remedy disadvantage in the previous revenue standard. You remember when we were talking about reason for IFRS 15? That's it. That's it. You just discuss it and elaborate it. Expand it well. Okay, based on your understanding of the conceptual framework and of course IFRS 15. You just elaborate it and give them something to think about. But you have the solutions there to guide you. Obviously, I've explained everything. Okay. You don't need to write all these long solutions. Don't mind them. Okay. So just go straight to the point and make sure what you are doing is right on point. Is that okay? Now, this is another question from Icon. Okay, so let's take a look. It said IFRS 15 on revenue from contract with customer was issued for the purpose of ensuring that revenue are properly accounted for, better than what we have under IS 18 and of course IS 11 required. Identify the 5-step model that needs to be followed by entities when recognizing revenue from contract under IFRS 15. Did you say again? That's it. There's no way they want to test IFRS 15 and they won't ask. And that's the column, that column I've just checked. So that's what you're telling them, all right? Now say, explain how IFRS 15 is expected to improve financial reporting. Oh, that's it. Comparability, disclosure, useful information, just play around that, right? A more robust approach to revenue recognition, blah, blah, blah. Okay, we have said all of them. Okay, so let's now look at the solution, the theory part, the calculation part. Okay, but the calculation part, this level has not really been tested. Okay, that first part is been tested in corporate reporting, but they've not tested the solution part. They want to take a look at now. So let's take a look. How do we go about this? Okay, it said Fontel Nigeria Limited is a network service provider registered with the Nigerian Stock Exchange. The company has been operating in the country for the past 10 years. So what's my business with them? Okay, don't mind me. All right. It said on September 1, 20X9, the company entered into a service contract with its customer to provide a special model handset and 1 year service at 1 year service at the price of 250,000. Okay. Now, if the customers acquire the handset only, it will be sold at 75,000. And if the network service is separately provided for a 1 year duration, the customer will be made to pay 200,000 for the 1 year duration. Okay, that's fine. Now, the financial year end of Fullness Nigeria Limited is September 30th. They have reasons for giving you the financial year end. Okay, so don't commonize that. All right. Now, I say required calculate the revenue from this contract for the accounting years ended 2019 and 2020 in accordance with IFRS 15. Okay, so when I see this question, I remember my model, my 5-step model for revenue recognition. Okay, so to make life easier, all right? So identify the contract with customer. So what is the contract here? Fullness Nigeria Limited is a network service provider. I'm still reading that one. It said on 1st September 2019, just like today, we're in 2020, 1st September. Sorry, happy new month, my people. I didn't even greet you. Even you two did not greet me. So the company entered into a service contract, with its customer to provide. Can you see that? That is the contract with customer. So that is the identity customer. Is that okay? Then identify the separate performance obligation. So what is sorry, I guess the network was fluctuating, right? I think it's okay now, Abby. Okay, so now what's now my separate performance obligation? I'll supply, special model asset and a what's it called? A special model asset and 1 year service. Can you see that? So that is my performance obligation. Okay, okay. So that's it. I've done my step 2. Then I move on. Determine the transaction price. The question will supply you at a price of 250,000. Did you see that? At a price of 250,000. I have identified my performance obligation, which is supply in my step 2, supply special model asset, and a 1 year service. Can you see that? Then what is my transaction price? 250,000. Then number 4, step 4, what do I do? Allocate the transaction price to the separate performance obligation. That's my step 2, based on standalone selling price. Did you see that? Then I asked this question: where is my standalone selling price? He said, the customer acquire the handset only. Did you see that? It will be sold at the price of 75. So I don't need any here to tell me that for my special model handset, the standalone selling price is 75,000. If the network is sold separately, can you see that? It will also, the customer will also pay how much? 200,000. So that's my separate performance obligation. Okay, that's it. Then I'm ready to go. So what do I now do? It's very simple. Okay, I will simply, take on, my figure here is 250, Abby. Okay, so I will now calculate. I will now allocate this. What's it called? Allocate this. What's it called now? Transaction price. Okay, which is of this 250. I will allocate it based on my standalone selling price before I can recognize what's it called? My before I can recognize my, what do they call it now? Revenue. Okay. So what do I do? I'll now say for the handset, it's 75,000. That's separate performance obligation. Then I'll show you the solution. Don't worry, but let me explain it first so that when I show you that, it will be quite easy for you. All right. So I will now say for my asset is 75,000, and for my, what they call it, service is 200,000. I will add it up. If I add it up, how much is that? That's 275, right? 275,000. So for the asset, I will now get a percentage. Okay, I'll say 75 divided by 275, which is the total. I will have a percentage. I will also say 200 divided by 275. I will also have a percentage. So that percentage I got for each of the standalone selling price for the special model phone, and of course the service, 1 year service. That's what I will now allocate on that 250, and that's how I recognize revenue. And don't forget that we enter into this transaction 1st September 2019, and the examiner says my financial year end is September 30th. So that means for this phone, I will recognize the whole revenue now because it's instant. But for the service, I will only recognize 1 year in 2019, and I will now recognize the whole 11 months. It's for 1 year, the rest 11 months in 2020, and that is the end of that question. So let me quickly show you how that was done. Let me show you. Can you see? So this is the way you do it. Can you see? So this is my handset and this is my network service. I'll now say performance obligation based on standalone selling price. Is it not 75? Is it not 200? Can you see? So you add it together. By the time you calculate the percentage, you have a 27.27. So make sure you use 2 decimal places so that by the time you add it together, you're going to have 100. Is that okay? You now calculate this percentage on that 250. So that's for your handset. So this is the revenue for handset. Okay. Then for your network service, this is the revenue. So out of this revenue for my network service, I only recognize for 1 month. So that's why here you see 1/12. Can you see that? So my total revenue for 2019 is 83,327. Can you see? Then the 11 month that is remaining, I'll take it to 2020, which is 166,673. And that is the end of that question. Can you see? It's quite straightforward. Okay. Well, me, I don't understand why company will be doing this. I don't understand, but that's what IFRS is saying anyway. Okay. So you can imagine how many contracts I'll be doing that for, okay? Each customer. Okay. So if you have been doing it at work, you can raise your hand, let's know. Okay. Now, so let's take a look at question B of that question, then we say bye-bye to IFRS 15. Okay. If you have more, if you have a little time, I will before we go. So let me see whether I can take you on other side. I'll just explain them without notes, okay? So just to remind you. But if you don't have time, no problem. Okay, I feel like teaching till tomorrow. Remind me. Now, on September 2019, Fontel Nigeria Limited sold 100 units. So let me just be highlighting it as I'm reading so that it will be faster for us. 100 units of Android tablet to a major customer at 200,000 each. Okay. Now the tablet costs it costs Fontel how much? 160 each, 160,000 each. Okay. The time of the sale at that the customer have the right to return. Can you see that? That is a variable consideration. And I was telling you the other time, if a customer has the right to return, then you need to consider it in your revenue recognition. So it has a right to return, okay? And then we have a refund within 3 months. Can you see? On expiration of the 3-month period, the customer can no longer return and payment becomes due immediately, okay? You know, in revenue recognition, you don't necessarily have to collect cash, okay, for you to recognize revenue. I'm sure you are aware of that, okay? So once you have been able to do your 5-step model properly, then you can go ahead and recognize revenue, even though money might not have been paid, okay? So, but since there is a variable consideration here, so obviously in the revenue that we want to recognize, then we need to consider that portion of the variable element. So we don't take it as part of our revenue. Is that okay? So what do we do around that? So now said, Fontel has entered into a transaction of this type with this customer previously and reliably estimate that 4% of the tablets are likely to be returned. So that means when I'm recognizing my revenue, I need to take into account this 4%, which is the variable consideration. I said, explain how the above transaction should be reported in the financial statement. It's very simple. So what do I do? Okay, for my revenue, I would say 200,000 multiplied by 100. That's my revenue. But because of the 4% consideration, I will remove it from it. So I'll say 200 multiplied by 100 multiplied by 96%. Okay, but if you like, you can just say 200 multiplied by 100 units multiplied by 200,000. Then you have that 20 million. When you have 20 million, you calculate 4% of that 20 million. What you have left is your revenue. Okay, so now and the your 20 million is your what's it called? Is your what's it called now? 20 million is your revenue in quote, right? It's not really the revenue. So now, but the actual revenue is I think it should be 19.6 thereabout if you remove 4%. So the difference between the two, okay, you now take it as a contract liability. Did you see that? You take it as a contract liability. Then the same thing goes to your cost of sales because the cost of sales, is 160. Did you see that? Cost of sales is 160. So you also calculate it, then you also incorporate that 4%. All right. So the difference between, the cost of sales, right, Abby? Okay, you now take it as a part of your inventory. Okay, so that's what you do. Then you also look at your, what's it called? Gross profit. Okay, so let me show you how you do that. So what you tell the examiner is this: when a customer has the right to return product, the transaction price contains a variable element. Since this can be reliably measured, it is taken into account in measuring revenue. So the total revenue, okay, is 19.2. That's what I want to say the other time. Can you see that? So you simply say that your 20 million multiplied by 96%. How did we get 96%? It is they said 4% to be returned. So I will not do 100%. That's it. Or if you don't understand that, just say on that 100 units multiplied by 200,000, we have 20 million. Then 4% of 20 million, remove it, you have 19.2 million. Is that okay? Now, so we now recognize what's it called? The whole 200 million as your receivable. Then this implies that 800 million, which is the difference between what's it called? Your 20 million and 19.2 million will now be regarded as a refundable liability shown in your current liability. That's contract liability I was talking about. Now, this you do the same thing for your cost of sales, all right? It's also 96%. Abi? So the difference between the total cost of sales and the cost of sales you are actually recognizing, you now take it as as a return of asset that they can return it. Okay, so you take it as part of your inventory. That means it has not even gone out of your inventory. So your reported gross profit will now be that 19.2 million minus your cost of sales. This is your what's the cost of sales here? Yes, Abi. Is it this? No. Yes. My actual cost of sales. Yeah. So that's it. So you now have a gross profit of 3.8 million. Okay, and that is the end of that question. That's it. All right. So it's quite straightforward. Okay. So but don't joke with the written part of IFRS 15. And in case the examiner is also bringing you on the calculation, at least you have an idea. So thank you so much for listening. Do you have any question for me? Do you have any question for me? So obviously, by God's grace, on Sunday, we'll take a look at ratio analysis. So let me take you on time. There is reason why ratios is taking last, because if you don't really understand accounting standards, all right? If you don't really understand accounting standards, then you will, you may not really, will not really get the what was it called, ratios. Okay. Um, okay, IS 19, the last question, the contribution was added. Which question is that? Okay, let me take a look at that. Which question is that? What's the name of the question? Uh, I wanted to use this last time to explain about two more standards without the notes, okay? But if you have questions, no problem. I will not be able to do that. Which question? Which question? Mention that question so that I can. What's the name of that question so I can clarify? Okay, just the last question, because I knew I also explained. I explained what's it called, the ICCA question, and there was a question we did before that. Mention the name of the question. The name. Okay, the ACCA. Okay, thank you. Okay, the ACCA question. Okay. So sorry, I'm still on the 5, 15 rather. Okay, let me see. Oh, okay, sorry. Okay. Contribution. Okay, in this solution, right? Okay, so let me see. What is the contribution? Okay. So what is the contribution? Is this the contribution we're talking about? If this is contribution, it's correct. Okay. Okay. Let's see. This is the contribution, Abby. That's what you're talking about. Okay. Okay, look at the question. Let's see the question. Okay, so let's see the question. I think there was a statement in that question. It said, okay, it said total contribution paid to the scheme, yeah, for the year ended was 17. Can you see that? It said total contribution paid to the scheme. You know, it's like you contribute, then it will be in jacket it will be, can you see, paid into the scheme. So you have this 17 there. Okay, that's the contribution paid into the scheme. Okay, is this mathematics that we are still trying to struggle with? Okay, all right, so you agree now. Thank you. So that's why you have it this way. Okay, so to be showing just like your other what's it called, here net position. Okay, in the previous example it was deducted. Okay, can you mention that previous example? Let me take a look so that we see the difference. Okay, just mention that name. Let me quickly go there. I think we did let's see. Sorry. Just mention the name of that question. Is it this one? Okay, we did this, right? Okay. He said, sorry. He said contribution paid into the plan, right? Okay. Now you look at the benefit here. Now, see, this is the contribution. Okay, it was 90. Is when okay when you have this 90, when you have this 90 here, you know, it's in jacket. Abby, it's in jacket. Okay. Now do the calculation here. Okay, let's do it. This is 660, 760. Okay, okay, this 660 in negative. Okay, and if you do this 100, what happens? It will give you, is it 550? Abby, that's 550, right? Okay, so do we have this? If you do all your calculation, sorry, let me try and get a calculator to do this so that I can clarify this sometime. Okay, okay, so we have 600 plus 60. Okay, yeah, so this is correct. This is 650. So what you do is you had 660, right? Then the service cost component, because it's a charge, okay? Then you have this 100. Then you had back this 960. You had this 960. Then you have how much is that? 650. Is that okay? So this is correct, I mean, because in this case, my what they call it, my plan asset is greater or higher than my pension liability. All right. So what happens? My contribution will now be it will be in jacket. Okay. Okay. So did you see that? Okay. So now let's now go back to that ACCA question. Let's go back to the ACCA question. Okay. Sorry. I'm trying to have people are trying to join. Now, if you come back to the ACCA question here, now here, now the contribution is 190 plus 9.5 plus 17, then minus 19 plus 27.5. Okay, then we have 22. Now this is correct. Yeah, it's correct. Now the contribution is in jacket over there because your plan asset is higher than your pension obligation. So when you make contribution, it will not still make your pension liability to be higher. So that's why it's in jacket. But when you come here, when you come here, when you come here, when you come here, my fair value of the plan asset is 190. Did you see this? My fair value of the plan asset. That means, what's it called now? My present my obligation. Let me show you the question. Let me show you the question. Let's see. What's the question? Okay. Now look at it here. The present value of my obligation is 200. Can you see? Then the present value, sorry, what am I saying? Present value of obligation at the beginning of the year is 200. Did you see? And the fair value of the assets, can you see? At the beginning is 190. So I have a difference of 10. Can you see? So that means my obligation is higher than my plan assets. So the contribution I'm paying, okay, the contribution I'm paying there will not be jacketed. That's it. Okay. But if it's vice versa, then you are going to put it in jacket. So that is to say, now let me go back to what's it called? What's it called? Yeah, it's asset ceiling. I understand what you're saying. Just hold on, hold on. Okay, it's because let me show you what we discuss here. Let me show you what we discuss here. Now look at it. contributions into the plan. That's why I spent a lot of time to explain this. Said these are the cash payments paid into the plan during the reporting period by the employer. This has no impact on the statement of profit or loss, okay, and the other comprehensive income. Now we said your net position will always be in deficit. Is that okay? It will always be in deficit. So that means when you have a deficit and you are paying into the plan, that's contribution into the plan, it's not going to be in jacket. Did you get the point? You leave it like that. So you just add up as part of the deficit. But once your what's it called, plan assets is now higher, which is already in negative. So the contribution you're also bringing on will be jacketed. That's it. So that because it will have no impact, it's just your cash payment. So what you are trying to do is, by adding it up to that asset, you are trying to, make your net position to, to improve because of the, what's it called, the asset ceiling that you're having. Okay, because you're having you're going to have future refunds, and you're going to have what's it called, reduction in liability. So the whole idea is that so that your future liability can be reduced. Okay, can you look at Selena? Okay, which one is Selena? Okay, is this Selena or Selena? Okay. Yeah. Okay. Now this is Celine, right? What's the question? Let's see. Sorry. Okay. So it said, let me see. Okay, this is the present value of the obligation. Okay. This is the present value of the obligation, Abby, and the plan asset. Okay, here the obligation is higher and the plan asset is lower. Okay, now look at your pro forma. Let me show you again. Now, this is your contribution into the plan. Did you see? Now, because this is what we have in the pro forma. Okay, I think I understand now. Now, here, so when you are doing it, naturally, you take it as a negative. Okay, so let me see. Let's see. So that is, where is that? So this is what we have here. Okay, now, in that ACCA question, there's a clause there. So let's see again. Okay. Sorry, we are just scrolling up and down. Sorry. Okay. Now, it said, assume that contributions are paid into the plan and pension benefits are withdrawn. So that makes the difference. Now, there's a relationship between contribution paid and pension. Now, I can't scroll up again, but open your pro forma if you have printed it. On that pro forma, pension benefit is not considered, Abi. It's always in dash, Abi. Meanwhile, your contribution will be in jacket. Is that okay? Now, this statement is now saying assume. Most of the questions we've been solving, there's nothing like this. So it now said assume that contributions are paid and pensions are withdrawn. So when you are solving it, what it means is this. Now you're going to consider pension benefits that were withdrawn and the contributions that were paid. So that's why when you came here, you now have your pension paid. Did you see? Now you have it in jacket. Then to be vice versa. So you now have contributions into the plan as a this is actually negative. Okay, this is actually negative. Okay, because when like we see this 190 is negative. Okay, this is negative. Okay, then this is also negative. But the benefits that were paid because it's coming out, you now put it in jacket. So it's vice versa because there's a relationship between contribution paid, which should have been in jacket, okay, and the benefit were also withdrawn, okay. So in that case, you now do vice versa of your pro forma. So that's what the what's it called? That's what that statement is saying, okay. So that's why it's treated that way, okay. So you just follow this instruction. I think I was mentioning it when I was trying to explain it earlier. I said, assume that contributions are paid into the plan. Contributions are paid into the plan, okay? So naturally it will be in negative. But then now said pension benefits are withdrawn, okay? So pension benefits are withdrawn. So since pensions are withdrawn, what do you do naturally if you withdraw? It will be in jacket. So you can't put both pension in jacket and of course contribution in jacket. Okay, so since there are contribution into the plan, which naturally will be in jacket, okay, but because it's withdrawn again, so you are showing the net position of the two. So it's either you now say minus times plus. So you can't say minus times minus or plus times plus. All right, so that's what is done there. Okay, so that's it. All right, so I think the time is gone. I was thinking I'll be able to. Thank you. Yeah, thank you for your observation. It's very critical. Okay. I was thinking I'll be able to give you some clue on some standards, but that question is also very important so that we are able to clarify that. Okay. So that shows we are following the class. And that's cool. So take a look at those questions. Make sure you understand them. If you have issues with them, let me know. So just bring my attention to that. Okay. I think let me let me just release it because of people that want to do SFM so that you can have about 10 minutes to take some water or probably eat some things. Okay, so I'm going to see you on Sunday by God's grace. So we're dealing with ratio analysis. Okay, and maybe intangible assets and obviously IFRS 8 operating segment. Okay, we have actually met our targets. We still have some time to take a look at some other standards. So thank you so much for your time. Thank you for your patience. Thank you for your understanding network issues and all of that. Okay, so I'm going to see you on Sunday by God's grace. So do take care of yourself. Have a wonderful evening. Thank you.